What monetary policy mistakes caused the Great Depression? Imagine a time when the economy was booming, then suddenly everything started to fall apart. That's what happened during the Great Depression, one of the worst economic downturns in history. But what caused it? Today, we'll look at the mistakes made by the Federal Reserve that made the crisis much worse. The biggest error was allowing the money supply to shrink sharply. Between 1929 and 1933, the Federal Reserve did not act to keep enough money in circulation. Instead, the money supply fell by about 1/3. When there was less money available, prices and wages started to fall. This deflation made debts harder to pay off because the real value of debt increased. As a result, many businesses went bankrupt and banks failed. Without enough money, banks couldn't lend, so businesses and people couldn't borrow to keep the economy moving. This created a downward spiral that deepened the depression. Another mistake was not doing enough to stop bank runs and banking crises. During this time, many people rushed to withdraw their savings from banks, fearing they would lose everything. The Federal Reserve did not provide enough support to struggling banks, which led to widespread failures. When banks closed, people lost their savings, and the availability of credit dried up even more. Without credit, businesses couldn't grow or even stay afloat, which slowed down the economy further. The Federal Reserve also raised interest rates in the late 1920s to curb stock market speculation. While this was meant to slow down risky investing, it also made borrowing more expensive. Higher interest rates meant less money was available for businesses and consumers. This move contributed to the slowing economy even before the stock market crash. When the stock market finally crashed in 1929, the Federal Reserve was slow to respond. Instead of quickly increasing the money supply to stabilize the economy, they waited. By the time they did act, the damage was already done. The economy remained weak, and recovery was slow. All these mistakes worked together. The shrinking money supply increased debt burdens, causing more bankruptcies and reducing spending. The failure to support banks led to more failures, which made the crisis worse. The tight monetary policy before the crash and the slow response afterward turned what could have been a recession into a prolonged depression. Understanding these errors shows how important it is for central banks to manage the money supply carefully. If they act too late or tighten too much, they can make economic crises much worse. The Great Depression teaches us that keeping enough money flowing and supporting banks during tough times is vital to prevent economic disasters.